Hello everyone, welcome to the analyst classroom. Today I'm going to teach you about the income statements and their some of the topics. This is the basic format of the income statement that start with the sales or revenue, also called as the top line. For example, 1000 is the revenue, COGS means manufacturing expense is 400, gross profit comes 600. SGA means selling general and administration expense 200. That gives us the EBITDA, earning before interest, tax, depreciation and amortization 400. Depreciation and amortization suppose 100. It gives EBIT, earning before interest and tax 300. Interest 50. It gives EBIT 250, tax is 100 and net profit 150. This is the basic simplified format of the income statement. Sometimes analyst needs to convert this into the common size statements to compare with the other companies in the similar business to convert the common this statement into common size statements. every Everything is divided with the revenue or sales. For example, revenue is 100%, cox is the 40% of the revenue, gross profit is the 60% of the sales, SGA 20%, EBITDA 40%, depreciation 10%, EBIT margin 30% of this revenue, net interest 5%, taxes and net profit margins 50% of the revenue. Analysts compare these, for example, company A with the company B, with what the company is gross profit margin in company B's. When you transfer these amounts with the percentage, you can easily compare with the other companies. This is the basic classification, and there is the another topic in the income statements called as expense classification. There are the two type of classification. The one is the based on the function, and other is the based on the nature. For example, cox means manufacturing expense. This called as the function based classification. Classification, yeah, depreciation, amortization or interest is the nature based nature based classification. You can for example company has two plants, plant A and there is a plant B. So suppose plant A depreciate by 100 to 10 90, and these 100 to 595. For example, plant B, it's not a plant, suppose it's a office building. Then uh, this is my revenue, this is the COGS. Suppose I have revenue of 100 and my cost of goods sold is 40. Then I can this dep this show this depreciation in this cox as a 10 and show uh, here is this is the nature wise. This depreciation is treated as nature wise, but here this depreciation of plant A goes into the nature function, and my this is to SGA 30 plus, for example, 535. This is also called function. You can categorize depreciation function wise or in the other nature wise below the EBITDA. So this is the basic understanding of the reporting. Let's talk about another topic called minority interest. Minority interest means those shareholders of your subsidiary which is not you. For example, there is a call guy Tom. He owns the company, chemical company, and there is another two guy which makes which owns 80% and 20% Jack and Jolly. This is the raw material company, chemical company, which supplies to this. So Tom wants to backward integrate his business. So he buys all the 80% share of the Jack. Now this company becomes becomes subsidiary of this company. Now when he prepares the balance sheet, consolidated dated financial reports, they show both companies' total income and expenses as this main company. But Jolie owns 20%. Jolie owns 20% of that subsidiary. So he need to show that 20% minority interest of Jolie in subsidiary. Okay, so this is the minority interest and revenue recognition. Now let's talk about the methods of revenue recognition. So IFRS, and US GAAP are now converged to use principle based approach to revenue. So there is a principle based revenue recognition. US GAAP mostly use rule based, but for the revenue recognition, revenue recognition, they use principle based. So in the revenue recognition topic, principle says that the main central principle, the central principle says that firm should recognize revenue when it has transferred a good or service to a customer. Transfer a good or service to a customer. There is the 5 step for process completing or delivering the pro- performance obligation. Let's talk about the topic. For example, uh, there is a contract company uh, take the contract to build shopping mall, and he will get the he will, he will get the mall for 150 millions of dollars. Okay, and it will cost him 120 million dollars. So in the first year of the business, he spends 60 million. Now he will recognize revenue by com- completion. 60 divided by 120, 50%. So when you recognized in year one, 150 into 50% plus 75 million. Now there is the another point in this revenue recognition, says that the revenue should be recognized if it is highly probable that it will not be reversed. Means, let me give you the another add-on in this. For example, this contract says that if he delivers the mall in 3 years, then he will get 20 million over and above 150 million. So if contract company certain about completing the building in 3 years, then he will recognize revenue 170 into 50% is equal to 85 million. If he is not sure, then he will recognize the revenue as this 150 into 70 50%. That's it. Mhm. Now another topic in the income statement is capitalizing the expense. There is a two way. Capitalizing means, for example, I I develop a medicine or a product in R&D, research and development. Then I can capitalize and show the cost in the balance sheet as a asset side, or I can show in the P&L statement as a expense. For example, 100. I can if you show here there's a capitalizing and this is the expensing and called as the capitalizing. Capitalizing means mm, you will get benefit of these cost in the future period, and this means you are not get benefit of this expense in the future. So capitalizing will increase the your profits, and capital expensing can reduce your profits. So the CFA or the this US and IFRS principles says that the cost incurred to secure the contract and certain other costs must be capitalized. Means, for example, in India, governments issue tenders for the government works for building the roads or riverfronts or the toll plaza. Then governments wants the guarantee, so he mandate the security deposit for specific contracts or some sort of fees. So these fees or the security deposits should be capitalized to get the contracts. So there is the another topic in the income statements. Uh, you must be seeing these lines called discontinued operations. If company wants the some part of his business to get close in the next year, then he need to show the that operations profit in the separate line items in the income statements. The income or loss of discontinued operation is reported separately in the income statement net of taxes after income from continued operations. And another is the unusual and infrequent items shown correctly. Unusual and infrequent, those events are unusual in nature or infrequent in occurrence are shown separately, like impairment, write-offs, or you got a robbery. Includes in the income from continuing operations before taxes. You get that you need to pay taxes of these losses or profits, get loss or profit in these operations. Then another topic is the changes in accounting policies. There is changing in accounting principle, changing principles or changing estimates. Principle means LIFO to FIFO, LIFO to FIFO, or FIFO to LIFO. Requires principle requires retrospective retrospective application. Retrospective application and estimates change in estimated of useful life of an asset or another. It is a prospective. Now let's understand about the retrospective and prospective. Retrospective means you must treat financial statement as if you have changed this method right from the beginning by adjustment of one. change backward and prospective means change now onwards. This is the basic, and that is the barter transactions. Barter transactions revenue is recognized at a fair value only if it can be estimated. Otherwise, revenue is recorded at carrying value. There is a revenue reporting. There is a two classification main gross and net. Gross means sale and COGS separately or net of sales and COGS. This is the main company's main manufacturing or business like airline companies, and this is the brokers like travel agent. For example, travel agent sells a ticket. For example, travel agents sells a ticket worth of 500, 5,000, and his convenience fees called commission. Commission 400. Then he will get the 500, 5,400. This is his he will get, but he will this ticket price ticket is not his earnings. He only report revenue as 400 and his other expense for that 20. So this is he will get only net of his commission only, not total 5,000 of ticket. This is the revenue recognition, and that's ends our basic discussion of income statement. I will make another separate video on the basic EPS and diluted EPS topic. Thank you for listening. Have a good day. If you have any query or suggestion, please leave a comment below. Thank you.